Hi, everybody. It's Helen Chorley, one of the co-founders of Property Sisters UK, and we are joined by the delightful Fiona Talbot for another look at the year ahead, 2021, and what we can expect from the market. So, Fiona, what are you thinking? What are you hoping for? What are you looking at this year?
I mean, I am loath to do predictions because, as we know, there's so much going on and so many macro influences that it just would almost be impossible to do.
Yeah.
I prefer to think in terms of fundamentals, like what is the key things that I need to be concerning myself with this year and making sure I'm managing my downside. So, one of the things that I'm really looking at is keep a fantastic financial house. Your financial house has to be in order. Do I have the numbers so that I can see the changes happening as they are happening? I don't want any kind of lag. So, what are my rents doing? What are my arrears doing? What are my costs doing? Because people are staying in their houses now. It's like driving the car an extra 6 hours a day. So will there be more wear and tear in my rentals that I need to be budgeting for when I'm doing my repair and maintenance reserves? So, I want to see those numbers, keeping that good financial house, keeping operations in order as well, dealing with my tax planning, my financial reporting and stuff like that. So
I think that's a great point. Cash flow and those cash flow projections, I think I see is where I've seen people this year and actually previously come unstuck, because these surprises pop up and people aren't prepared for them. Well, if you have the numbers, like you say, there's no surprise.
Everybody's staying in their house. They're working from home now. That's more wear and tear. It's common sense to think that's more wear and tear on my properties. So I need to to be looking at that sort of stuff. And then, one of the things, I'm quite a simple person when it comes to investing. I invest in an asset and I want a return. So, what return am I going to be getting? I mean, in a perfect world for me, asset prices are dropping. So when I purchase and my rents for me in my area are staying the same, if not rising, I will be getting a better net cash flow. But will I be getting the capital returns? Because, for me as a property investor, it's sort of two-pronged. I get capital growth and I get my net cash flow. Well, now the focus is definitely for me on net profit, net cash flow. Yeah. So I can actually, just to give an example, I'm buying a one-bed city centre flat. I agreed it at 140. Now, I know there's a conversion going on a couple of doors down, literally, and the one beds will start at 230. So I was willing to agree it at 140, give it 2 years, and then see what it does to the capital value. And it was yielding, it would rent for 750. Now, the value has come back and downvalued it to 130, but the rent, he's said, agreed to 750. So I've gone back and said, well, it's been downvalued. I'll buy it at 130. I've used it as a kind of negotiation tactic, and await the response from the seller. I can acquire that at 130 with 750 rental. I'm probably clearing close to £500 a month. I'll need to put 45k in, and that's a 9.8% return. I think it is on that money. So yeah. I could buy those all day, all night. But what's happening to asset values I'm looking at this year, because actually for me, when they get cheaper, it actually is a good place for me because I'm not a trader or a seller. So I'll be able to buy cheaper. But I'm also going to be careful not to dilute my working capital pot too much during the year on these. So I'll be wanting to buy sort of special deals or something that's got some kind of an exception to it. Like that one, I know, put it on a 2-year fixed. In 2 years, I'll be able to get the balance of my money's back out. Sort of a bit of a slow recycle, 2 years, but and or I can sell it. Maybe it's 180, 190k. Quick win, capital event. Take the money out, stick it in the working capital pot. We'll see. So
I love that planning. That's a beautiful example of planning for all the different exits. Which people talk about, well, what's your strategy? How about, can it be something, can it be all things to all men? Like the more you have, the kind of the safer that asset is. I love that. Beautiful example.
Yeah, and it's very much now I'm sort of like looking for deals that have a play, some kind of play that makes it a bit special. Because I can buy vanilla buy to let all day, or but I want to buy I want to buy assets that that have some kind of second play that would work.
Yeah,
and
little Brucey bonus in there.
Yeah, and I'm being very, very careful as well, because there's a lot of I've seen more than ever that there's a lot of the sharks are sort of out there, and there's a lot of people also. I'm finding, I call it COVID crazy, get a little bit of COVID craziness going on, and trust no one, check everything. So I'm sort of making sure that the deals, I've got that and a commercial deal going through at the moment, and I'm also sitting on a lot of my working capital too, because I'm still not sure where the market's going to find itself, because obviously we've got to see what the government's going to do. But and then I can go in. I mean, my favorite method is close for cash with a discount, sharp pricing, and then refinance, optimize, and then refinance, take capital back out. Not always all of it. Maybe you might have to leave a little bit in, but then when I'm leaving it in, that net profit, I'll look at the payback period on the residual capital. So if I've left 50k in and I'm making 500, you can do the maths on how many years that might take you. That's probably a bit longer than I'd like. I might like to see that residual capital replenished within, say, 2 years on what I've left in the property.
Right.
But it's always, for me, it's about looking at the deals in 3D. You've got to look at the whole picture. And I think this year more than any other year, well, it's good habits anyway. Back to that idea of the focusing on the fundamentals. You've got to be very, very careful, because, as property investors, we wear many hats. We've got to understand contracts. We've got to understand finance. We've got to understand valuation. We've got to understand repairs and all that sort of stuff, even design. That's like the area I'm always struggling at, but because I'm about the deal. But we've got to understand all these many things, and often we beat ourselves up because we don't always, and tax too, by the way. Tax also very important to understand. We don't always understand all these different areas, and it's about where you're weak, bring in the right advisors, and they're not always on Facebook, and they may cost you money, and
they are, but they're an investment. A good one is an investment in and of itself, isn't it? And you touched on something that is certainly, for me, is one of my New Year's resolutions, and I shall get better at it this year, is delegation.
Yeah, and exactly. I think someone said to me once, you've got to be the conduit of work, not doing the work, because I'm somebody also that my default is always just to jump back in and just get on with the cold-faced nitty-gritty stuff. And I mean, boring, nerdy example, in December, I decided to create a debt dashboard. So my financing across my portfolio is broken down to unencumbered assets, but then you've got to think about what's the opportunity cost of the money tied up in those. Yeah. And then it's private financing, individuals that have lent me money, secured first charge, always paid. And then I have bank finance, high street bank finance, and then I have is it subprime lending or whatever you call it, those other banks. And I broke it all down into my pay rates, and then I have a global pay rate. So my KPI for this year is, how do I reduce my global pay rate? But normally I would sit there like the nerd that I am and build that spreadsheet over 2 weeks, and instead I've got a financial controller that works for me, luckily, and I set the framework up and she set the dashboard up for me. So, it's, and if you can't, obviously, you don't have someone you can pass it off to, I would say that it's, if you've got more than a couple of lending, and I was a bit surprised even for me that there was areas where I thought, ooh, you know what, if I could save 0.25% here, man, that compounds out to quite a decent saving. Yeah, and I didn't think to do it and decided to do it in December. This is when you've got a little bit of downtime, it does too, you start thinking of these things. But anyway, just, looking at 2021, you've got to stay safe, healthy, wealthy, and wise. You've got to actually be smart, be careful who you're listening to, because there's a lot of noise out there and they're not all right. I see it online, and, so even certain strategies that I exited a couple of years ago because they just weren't performing for me, and there's still people out there training on those strategies. Maybe they've found a hack that I haven't, but making sure that what you've got is working. Consolidate what you've got is already. Don't be taking risks. because, you know, you're fearful. There's a lot of people making decisions out there, you know, from a place of fear, also acting like, you know, a bit of an arsehole as well from these places of fear, you know, as I've seen that over the last 12 months. And, you know, if you're going to go into a new strategy, be very careful as well. So I'm looking at doing a small development in this car park, this one deal, but it's within my bandwidth. I wouldn't be doing a deal converting a building to 24 flats. You know, that's just not something that I've got skills in and I normally would be doing. And then, yeah, just being, if the market is starting to soften, you know, I had the down valuation report on Monday. It got valued on the 21st of December. The report came in, I chased it, I had it Monday. You know, that to me is a little bit of a sign. And, you know, I need to be watching the market to see, because you don't want to be last to the party. You want to spot these things, you know, sooner rather than later. I mean, Tony Robbins, I'm not the greatest of Tony Robbins fans. I'm more a Brendan Bouchard fan, but he's got a thing going around saying winners anticipate, losers react. And I don't like to think in winners and losers, but I've always said you've got to be forward planned and be thinking ahead, not just sitting there in a place where you're starting to react.
And like you say, because that when you're in reaction, you are more likely to be coming from a place of fear. And that's a very different vibe. It's a very different mindset, isn't it? Well,
you've got to be able to, I mean, you worked in trading and, you know, you've got to be able to control your emotions. So, you know.
Easier said than done sometimes. In this year particularly. So thank you so much for those words of wisdom. I love what you talked about. Be cautious, but plan ahead. Look at your numbers, stay on top of those. Look at cash flow particularly, which caught a lot of people out last year, but hopefully they've been able to kind of rebalance that.
If you've got a little bit of downtime in your business, use that to strengthen what you've got going on already. I mean, I find property people get itchy feet. They have capital and they need to deploy it, but sometimes actually sitting on it is the right move. And, you know, making sure that everything you've got going on is working. You don't have to spend it, you know, wait and see what we think, you know, what lies ahead and what the market might bring to us.
As your friend and I, Richard Little, say, don't be a motivated buyer.
Yeah, exactly.
So lovely. Thank you so much for joining us, Fiona. Hopefully we'll get to touch base with you later on in the year and see how things are going for you then.
Great. No, thanks for having me.
Thank you.